All right, good morning, everyone. It's Friday, May the 9th, and thanks for attending this morning's 7 Investing podcast. My name is Simon Erickson. There are a lot of companies we could talk about today. This is a very, very busy earnings week. Everyone seems to be reporting really fantastic results for the most part. Had no shortage of options to bring onto the show today, but I'm going to bring one that actually might be a little bit unexpected. The company that I'd like to talk about this morning is what might not even be on your radar. It's not a sexy tech company. It's not one of the Mag 7. It's not even an S&P 500 large company. It's a very small, one would call a value stock. It's Crocs. CROX is the ticker on this one. This is a global shoemaker. In fact, I've got pairs of them. Anyone who is a fan of Crocs as much as our family is knows that the clogs are quite popular. They're a very leisure shoe. They're a very comfortable shoe. Nothing flashy about them, but you can also add fun things. The gibbets, you can put on different teams and logos. Fun things for kids, great for adults. And they're selling 4 billion pairs of shoes every year. They're very quite popular all across the entire world. The reason that I want to talk about Crocs is because this is a company that is chock full of catalysts right now. This is a small company, again, very steady grower, not growing 20 or 30%, growing maybe 4 or 5% per year, but it's just chock full of catalysts. And we got earnings yesterday. I want to walk through them really quickly, but then even bigger than picture than that, I've been professionally an investor for the last 15 years. I look for catalysts in small stocks like these that maybe are not appreciated by the rest of the market. If you're going out there and you're buying the hottest stock and the one that you got a tip from your barber and everybody's talking about it and it just seems like the expectations are already built in, it's hard to make money on stocks like those. What I far prefer is companies that are either being ignored or purposely avoided by institutional investors and a lot of big money for reasons that might turn over the longer term. I think that's where the true opportunity is for investors. And Crocs, to me, is just a quintessential example of that. So let's go ahead and share. I'm going to go ahead and share my screen here. Hopefully, this is going to work. I'm going to bring up Crocs' most recent report, which we just got first quarter results. Hopefully you can see the screen there. Okay, perfect. Press release came out on May 8th. That was just yesterday and says, hey, we reported better than expected first quarter results fueled by outperformance in both the Crocs and the Hey Dude brands. Again, they've got the core brand, which is the Crocs brand. They've also acquired a company called Hey Dude a couple of years ago. Nothing stands out necessarily in this press release, but I want to point out, how we can size up like things like this and find the nuggets that are truly golden in a company's press release and something like this. At first glance, it's not so obvious, but there are things that I want to pull out of this. First of all, look at this. Our financial strength enabled us to return shareholder value through $61 million of share repurchases. So they're buying back their stock. That's generally a good sign when management says, we think our stock is undervalued. We're going to buy back our own shares. Also, look at this. We saw revenue at the top line really not growing anything. Nothing's knocking it out of the park here, right? 1.4% on a constant currency basis for their consolidated revenues. But interestingly, gross margin increases right now. A lot of people would think with tariffs and the trade negotiations being kind of tense on a global scale, that a company like Crocs, who manufactures 25% of its product in China and 50% of it in Vietnam, might see gross margins falling significantly as these tariffs go into play. Now, what did happen is they did stockpile inventory. They kind of front ran this a lot. They brought in a lot of product in advance of these tariffs. So maybe that's why gross margins is looking so good. They just moved a whole lot of product and kept their pricing point obviously very stable. But the other thing that I want to say is, it's good to see gross margins maintaining the margin profile that they are right now. And keeping in mind, look at this, an operating margin of 24%, 23.8% here in the quarter. That's very high for a shoe company. It's very high for any retail company. This is not a tech company. This is not a Tesla selling electric vehicles. This is plastic shoes that's getting a 24% operating margin, very strong. And then the other thing that I want to point out that might stand out, might not stand out, but I think it's worth pointing out is that look at this. If you're getting only 1.4% top line growth, but then that's translating into a 24% margin, and it's also leading to a 13.2% growth in earnings per share, you've got a very lean, very productive and efficient cost structure of this business. And that's why you're able to get a 13% growth in earnings off just a 1.4% growth in the top line. A little bit more in here, we can go through kind of all these. Again, we stockpiled a little bit of inventory. They borrowed some money, not only to stockpile that inventory, but also to kind of pay back some stock. I now want to look at another thing. This is in addition to, let me back out of this. Bear with me one second. We're gonna come back out of the sharing. We're going to share something else. We're going to share another screen, which is going to show my recap of the CROX quarter, which was right here. And so for 7 Investing, we're making stock recommendations each and every month. I like to kind of cast a net of what's going on out there and then capture the most important things to provide for our own recommendations, for our own subscribers, and kind of keep track of what's going on. And again, here's kind of some of the things that we talked about, the split at the top of the revenue and the share. But then look at this. Negative cash from operations, negative 67 million in cash from operations because they were stockpiling inventory. And then they also issued debt on top of the negative cash flow to repurchase shares, right? They bought back $61 million worth of shares, and they have $1.3 billion authorized that's remaining. So Crocs is basically making a statement right here. It's going out, it's buying a whole lot of inventory in advance. To retire up to 20% of its outstanding share count right now, based on the authorization that they have for the buyback. And then look at this. The global trade environment has made it very challenging to predict how consumers might respond in the future. We're withdrawing our guidance for 2025. That's a big statement to make for a company to say, hey, we're only 1.4% on the top line. Our earnings are growing stable, 13% growth in earnings. We had negative cash flow for the quarter. We stockpiled inventory. We issued debt, and still the stock is up 10% on the news. It's almost amazing when you see a stock like this with no clear catalyst, not great top-line growth, modest bottom-line growth that is going into a little bit more debt for the quarter. It's up for 10%. Now, why? Why would it possibly be up on news like this when it's pulling its own guidance for the full year? It's a retail company that's highly exposed to Southeast Asian trade and imports. I think Crocs is in a win-win-win situation. There are hidden catalysts in that report and the company's structure itself that are underappreciated by the market, but we're starting to see the pendulum swing a little bit the other way. We certainly saw that on the results yesterday. We saw the stock go up on what most would interpret as a ho-hum first quarter earnings. Win-win-win. The first win is that the stock price just stays really low because there's not a whole lot of investor confidence in Crocs. And so what is the management team going to do? Well, it's going to take all of the cash flow and the operating margin that it's generating, and it's going to buy back a lot of its shares at a discount, right? So we said before, $1.3 billion share authorization is on the table. And you've got a stock that right now is selling for less than 7 times trailing free cash flow. Even if that comes down a little bit because of tariffs, even if it's still printing at least a 10 or 15% cash flow margin, if it's just going to pump that right into buying back its own stock, you're reducing the denominator of any earnings per share or any other per share metric that just looks more and more attractive for shareholders. So it's juicing the metrics on a per share basis by buying back a boatload of shares at a discount. That's the first win. The second win is that the trade negotiations go better than expected. A lot of people are looking at that 25% of production being done in China. They're saying, oh my goodness, there goes Crocs' margin. There goes the cash flow they were generating that's just going to get axed because of the tariffs that are going to impose on a company like this. We've already seen a lot of negotiations with the Trump administration and other countries to try to reduce that trade rate, that onerous tariff. The reciprocal tariffs that got announced a couple of months ago. One of the first to get on the phone was Vietnam, saying, hey, what's it going to take America for us to get to a 0% tariff rate versus whatever the announced rate was at the time? And very quickly, you could see why a lot of retailers, Crocs included, Nike included, a lot of companies that are manufacturing in Vietnam went higher on that news because the bad news was already priced in. The models were showing the reciprocal tariffs in a 5-year period. And then maybe now it's going to get a little bit better than expected. So first good news at Catalyst is a repurchase of shares. Secondly, is going to be the tariffs are getting better. And then the third is going to be just improvement in consumer buying behavior, specifically the Hey Dude acquisition that they made a couple of years ago. Really probably a bad acquisition. I think it's fair to say this was not a good use of capital allocation by the company. went out and acquired a brand, wanted to resonate with the younger generation. For anyone who has teenagers or young kids, can appreciate sometimes they don't behave the way you think they're going to. This demographic is notoriously hard to sell to, especially on a retail environment. Hey Dudes was mocked. And, there were videos going viral saying, hey, these things fit like boxes of Kleenex and they're not worth it. And just, it's been kind of a failure. You've seen a slide in revenues for several years since that acquisition. And in fact, in the first quarter too, we just saw year-over-year revenues for the Hey Dude brand down 9.8%. Continued slide. The company has just hired Sydney Sweeney, a very popular American actress, to be their marketing and brand ambassador for the Hey Dude brand. If they can even just get this back to break even, we don't have to see 10 or 15 or 20% growth. But if we can just stop that slide and get Hey Dude back to growing 1, 2, or 3% per year and just kind of break even where it's not a lingering decline on the earnings being produced by the rest of the core brand, that's a giant win right now. I think that one of the reasons that Crocs is priced at 6.5 times trailing cash flow is it's being modeled to be perpetually in decline because of Hey Dude, because Hey Dude is dragging down results. I think that this is still a small part of the overall pie. About 20% of overall revenue is Hey Dude. The core brand is 80%. So that's really where the cash cow is coming from. But if we can actually turn the ship around, even at just modest growth, that's going to give a little bit of confidence back into the market. So again, quick podcast today. I did just want to talk about a company, like I said, that probably wasn't on a whole lot of people's radar. We got earnings from a lot of companies. You see the pops from companies like the Trade Desk. You see companies like Transmedics. Some of these are really kind of more in the headlines. But I'm really excited of all things about Crocs. I think that's going to be a really interesting one to be following along with CROX. And before we go, I want to talk about one more thing too. This is something else I'm really excited about, which is a brand new partnership we just started with 7 Investing. Use profit.com/7 investing. Profit, PROPHET, and then /7 investing with the number 7. This is a new partnership. Profit is, I've known Emmett, I've known the CEO of this company for several years now, and I'm very selective about who I will promote on our own show. I don't just go out and do this with anyone, but this is one that I actually kind of like because there's been a lot of talk about how do you use AI in the investing industry. AI in some form has kind of been in investing for several decades, right? Even if you go back to kind of just the buy and sell signals, you would see a chart and you'd see an arrow pointing up saying buy low, and then you'd see an arrow pointing down saying sell high. And it was all just kind of technical analysis, right? I was looking at, this giant auction that we call the stock market and where were good buying support prices and where were good selling support prices. But that is not what Profit is doing. Profit is using AI to codify so many of the smartest academic researchers that have tracked companies and businesses. And then that has flowed downstream into stocks as an evaluation of those businesses. If you looked at the masters, if you looked at the Clayton Christensens of the world that created the Innovator's Dilemma, if you look at the Pat Dorsey's of the world, the little book that builds wealth, and kind of put all of these fundamentals into an AI engine to identify those signals of great companies. And then couple that with a little bit of sprinkled in technical analysis of saying, okay, when do I buy? What's the stock that I should be buying right now? You can see this is working, right? They've got now 5 terabytes of data. They've proven this over a 16-year time frame, and it's getting a 21.6 annual average return. There's not a whole lot of context in this. It's the AI engine doing its thing and recommending buys and sells each and every month, which is why I think it's such an interesting partnership with 7 Investing, where we like to go out there and talk about these stocks a lot, whether it be on these podcasts, whether it be in our own community forum, whether it be in our 5 monthly best buys. That's kind of where the conversation and the insights and the discussion bubbles up. But I love using a very powerful tool like this AI engine from Profit to uncover some new opportunities. A lot of the times, companies that we never have looked at before, right? International small cap value stocks are being recommended that, maybe I wouldn't have found. And so we're kind of expanding our peripheral vision with this new partnership. I'm very excited about it. They've not only given our audience a $50 discount. So instead of paying $299 a year, you're paying $249 a year. That's about $20 a month, broken down on a monthly basis. But on top of that, not only giving us a free trial of a week or even of a month, but 2 months, zero cost. So 60 days free to go in and check it out. Just take a look at a couple of the stocks that they're recommending and the buying and selling of the rebalance of the portfolio every month. I'm pretty excited about this. Again, this is an exclusive offer for our 7 Investing audience. It's not something they're offering anywhere else. They're not offering the discount nor the 2 months free anywhere else. This is something that we're getting just for our audience, which I'm pretty excited about. So that wraps up today's show. A company for your radar with Crocs, a new partnership, useprofit.com/7investing for you to check out if you'd like to. We'll be back again with more earnings coverage next week. I'm going to have to dig into A&D. I was pretty excited about that company right now. I'm going to have to dig into Rocket Lab, one of my favorite companies that I was pounding the table on when it was $4 a share, and now it's up to $25 a share. And by the way, Neutron is on track to launch in late 2025. That's going to cause a skyrocketing price for this stock that is focused on the space economy. So we're going to be talking about even more of those next week. Appreciate you tuning in for this show of the 7 Investing Podcast. We are here to empower you to invest in your future. We are 7 Investing. Have a great weekend.